But in my travels, I was absolutely convinced that there was a need for a deeper dive book. I would typically speak at a conference. I'd walk off stage and I'd have discussions in the hallway for another hour. And I felt like there really wasn't something comprehensive. You could get that short little snippet, but you never really had the opportunity to tell the whole story.
Okay, episode 43 of the Deal Ranch podcast. Tony Davidow. I'll let you give your intro because you have so many different titles in what you're working on right now with the book you're writing, Private Markets, and then you're the Senior Alternative Investment Strategist at Franklin Templeton. But you've spent your life in private markets. You've spent your life in alternatives. So I'm looking forward to hearing that. Thank you to Rick Schaup and the Clarion team that made this introduction. So Tony, thanks for hosting me in your podcast studio.
Well, thank you, Matt. Thanks for having me, and congratulations on 43 episodes. That's fantastic.
I appreciate it. Do you want to give an intro on yourself, kind of overview of where you are today, and then we can go through your career like we talked about earlier. I think that'll be good.
Yeah, and I'll just start with kind of the basics. I was hired by Franklin Templeton initially to build out our alternative education initiative for our wealth channel. And as we started to do that, I think the firm recognized early on that this is a journey. This is something where we need to have an ongoing commitment. And I thought I was semi-retired and living a comfortable sort of life, kind of picking and choosing projects that I wanted to work on. But I got really excited about the opportunity at Franklin Templeton. I thought there's something special going on here. I thought, the acquisitions that Jenny Johnson had made and acquiring these world-class institutional managers made this an interesting firm. And I thought the opportunity for me was to help advisors think through that allocation of capital to alternative investments. And I think as we'll get into throughout the discussion today, alternatives mean a lot of different things to a lot of different people. There are certainly advisors who are power users who have been using these strategies for decades and decades, and advisors who are new to it. And we need to figure out how we meet them on their journey to help them along the way.
I love it. So we'll get into kind of how you transitioned over here in a little bit, but what is your origin story in the investment world and then in alternatives and private markets? I was reading you started in a family office that did some private equity deals, did some private real estate deals too. So kind of how did you end up here in the long run?
Yeah, I don't know that I have the typical sort of story. I began my career working for a family office, which I think a lot of people think that's maybe where they want to end their career. So, I was a young kid. I got an incredible break, had the opportunity to work with a family office. And we did make a lot of investments in private equity and private real estate at the time. And I think it gave me a different vantage point. It gave me the opportunity to see how large families think about allocating capital. And to them, allocating capital was how do they fulfill the dreams, aspirations of the family? How do they think multi-generational about transferring wealth and creating wealth and providing opportunities to the causes that they believed in. We had multiple foundations that were, kind of near and dear to the family as well. So I actually began looking at wealth as more than just money and your balance sheet, but what could that money in fact do for you? And I think it helped form the way that I think about allocating capital for every sort of role that I've had ever since.
Wow. So what were you doing at the family office? Were you evaluating new deals? Were you looking at new markets? Were you doing research? Like or were you doing everything? What was
we were a small family office at the time. I was a sponge. I was a young kid who knew nothing, and I was trying to absorb everything that I possibly could. We did a lot of investments with outside experts, and I was just a sponge trying to absorb as much as I could about how do you evaluate private equity? How do you evaluate real estate? How do we think about the various trust setups? So obviously the family office had, tax experts on site. We had an investment team on site. We had all sorts of outside experts that we worked with. And I was just trying to learn as much as I could. I was a young kid at the time, but it provided a tremendous foundation that I think has carried through the many years since. And that was 40 years ago, and I still think about those days. And I really think about the lessons that I learned there and how maybe at the time I didn't realize how formative they were, but I certainly think about that today.
Wow. The Morgan Stanley role seemed like a significant learning point and also time in your career. Do you want to walk through those days? Because it seemed like you had a couple different unique roles, but an evolution there that got you into different markets.
Yeah, I loved my time at Morgan Stanley. I was there for roughly 15 years and had three primary roles. My first role at Morgan Stanley was building an institutional consulting business. So I worked directly with a lot of big endowments and foundations, public funds, Taft-Hartley plans, and again, realized, kind of firsthand the importance of allocating to alternatives to help fulfill whatever they were solving for, whether it was funding charities or meeting liabilities for retirees. From a firsthand perspective, I saw the value of having significant allocations to alternatives. Not surprisingly, I was a disciple of David Swensen and the Yale Endowment and the work that he did and how he really pioneered the way that we think about allocating capital today. So I ran that business for roughly a third of my time there, and later was asked to transition into running a little business that we had acquired. We bought a multifamily office called Greystone. And Greystone, when we acquired them, was really, their expertise was in the area of alternatives. So it really brought open architecture alternatives to Morgan Stanley's private wealth business. And that was probably, the most exciting role that I had throughout my whole career, because I had the opportunity to work with a lot of founders and family offices in allocating capital. And in addition to being responsible for the Greystone business, I was also a member of the firm's client strategy group. I was the asset allocation and alternative investment specialist, which meant that I met with every one of our big banking clients and helped them think through their allocation decisions and helped them think about allocating capital across our alternative lineup, which at the time was, I think, one of the biggest and broadest across the street and one of the first that really had true open architecture. And then my last stop at Morgan Stanley was really designed to leverage those experiences I had at my first two stops, where I ran sales and training for the wealth channel, also known as the retail channel. We don't like to use that term, the private wealth channel and the institutional client segment. So I really had the opportunity to bring some of those experiences and talk to individual investors, the wealth channel, the advisor, about how to allocate, how families think about allocating capital, how to really, up your game and improve your investment acumen by expanding the toolbox that you're bringing to your clients. So I think, again, that was probably one of the most influential parts of my career, because I was able to leverage my early experience working for the family office, really take advantage of the access that we had at that time, which was cutting edge and very differentiated relative to other firms on the street at the time, and then start that journey of introducing this to the wealth channel, which a lot of these investments were relatively new to them. They didn't always have access to or eligibility to get into some of the best funds that were out there. So I've really watched as that's evolved over the last couple decades, and we're certainly at a different inflection point today than we were at the turn of the century.
A couple questions from that time period. Even though it was early on in your career, of all the investment realms to go into, like, what kept you interested in alternatives and private markets? And then two, I think probably a good point to define in your words, like how do you define private markets, and then how do you define, like, what is inclusive of alternatives? Because that can obviously get thrown around to include different things now.
Yeah, and I would say that's one of the confusing things for advisors. The term alternatives has become somewhat of a catch-all. Mm-hmm. Anything that isn't traditional investments, including things like crypto and NFTs, get thrown into that alternative bucket. I guess I'm more of a traditionalist. When I think of alternative investments, I think of alternative investments include private markets, private equity, private credit, private real estate, and hedge fund strategies. That's it.
Okay.
And we really don't go outside of that. I'm not going to quibble if somebody thinks that crypto is an alternative investment. It's not a traditional investment, but I don't think it fits the traditional sort of definition of what an alternative is. Mm-hmm. It's not an asset class per se, and it's not necessarily a structure designed to provide different outcomes. It's a speculative investment in my mind. But why I've stayed interested in that space, candidly, I think it's just the most exciting. I think it's the most exciting set of investments. And, I think it's interesting when I go back in my early days, working for the family office, we didn't really think of them as being anything different. We just thought about if we could find opportunities to invest in young companies, invest in great entrepreneurs, we thought we could have different outcomes, and outcomes that would be far superior than you would get in the public markets alone. It was just very simple the way that we thought about it. And again, I think my experience working with institutions, ultra high net worth families and family offices, there was a belief that if you had that sort of wealth or that sort of money, that you wanted access to things that not necessarily everyone else could get. Right. Well, what were the things that the other people couldn't access were these unique investments called alternative investments. So it definitely has evolved quite a bit over the last couple decades. I would say today what really makes it exciting is for the Wealth Channel, they have access to many investments they never had exposure to, private markets in particular. Up until the last decade, they really couldn't access all of these great ideas. They might have dreamed about having exposure to the next Apple, Google, and Tesla, but the reality is they couldn't, and they had to wait until they come to the public markets where much of the growth has already been appreciated. So to me, it's exciting. We're getting access to world-class managers. We're getting structures that are more conducive to the way that individual investors think about it. So we think this is a great inflection point. And it's still the early innings of advisors adopting private markets in their portfolio. But I think as an industry, we've likely evolved from why to how.
Right.
And I think that's a pretty big thing. I think advisors generally recognize the intellectual argument is easy. They understand they should have exposure to it, but now they're asking the question, how?
Yeah. We can save that question for when we get into your current role, because that's the big question. And I think why you're working here is to help answer that for a lot of people. And your book and your podcast too. So 2 questions before we get into current, really focus on the current days. Can you expand on like it'll be a good foundation for the conversation, but like the primary goals I've read it in a couple of your white papers, but the primary goals of alternatives and what they do provide fundamentally, you think?
Yeah, and I think that's one of the, hopefully that's one of the signatures of, the way that we approach it. I think the trap is to falling into selling these things as products and selling the returns. The way that we think about it is, I think, very consistent with the way that institutions think about it. The Harvards and the Yales of the world, they think about adding private equity to their portfolio because historically it's provided an illiquidity premium, that excess return that you get for committed capital over the long run. They add private credit because they want to increase the income in their portfolio. They want to get income above and beyond what you would get in the traditional markets. They might think about adding real estate because real estate can be an effective hedge for the impact of inflation. Yep. And they can add hedge funds because they want to be either offensive or defensive in nature. And if you start to define things in those terms, what they do for a portfolio, what role do they play, it makes it a little easier when you get to that more difficult discussion about the how, because the question about how and where to source private equity, if I've already defined its role in the portfolio is to provide growth, I'm going to take it from my growth bucket. If private credit is there because it's going to provide income, I'm going to take that from my income bucket. I'm going to take real estate from my defensive bucket. Real estate's one of those unique asset classes, as you know well, that provides growth, income, defense, and inflation hedging. So it's kind of the four-legged stool, I guess, the way that you think about it. They really provide all elements that you're looking for in portfolios. But I think that's a much more constructive conversation to have with advisors and investors focused on goals as opposed to the jargon that we often fall into, or worse yet, focusing on the performance, which can be fleeting.
Wow. One thing to round out kind of your history, you growing in the industry, one thing that's evident in your podcast and then also in your white papers is your kind of interest or like I guess value, just a quality, someone you value, Swenson, in what Yale has done. So can you break down what they've done and kind of how that's I would say drastically different than how most people look at portfolio construction, but for those that aren't familiar, and for someone who it seems like played a big role in your career, what's the impact of him and their platform?
Yeah, I'll be honest. I think David Swenson was the most influential investor of our generation, and for people who don't recognize that, they haven't read his work. David Swensen, as you know, and hopefully many of the listeners do as well, David Swensen was formerly the CIO of the Yale Endowment, and he famously took the Yale Endowment from a roughly 10% allocation to alternatives when he joined in 1985. To most of his career, it was 70 to 80% allocation to alternatives. So what David recognized, largely the growth and the opportunities would be in the alternative space. He believed the inefficient assets were really, we should be making the biggest bets because that's where the outsized returns will come from. Now, as much as I love David Swensen and I have followed the Yale endowments or probably looked at their allocation for every year for the last 20 years, the reality is I think it's important to be aware of the way that Swensen and big family offices allocate capital, but I wouldn't suggest that advisors blindly follow that. I don't think that most individual investors would have the tolerance for 70% allocation to alternatives or a 50% allocation to private markets. But I think it is instructive in the sense that it does give you directionally where they saw the biggest value and the opportunities, not just with Swensen and the work that he did with Yale, but I think what we've found over the last several years is a lot of big institutions have similarly made big bets on alternatives and smaller bets on the public markets. Now, for the individual investors, I always caution them, you need to think about how you allocate capital. And the biggest concern and impediment for, I think, a lot of individual investors is illiquidity. They don't have the tolerance of a Yale that can think, perpetuity is their time horizon. And if they need more capital, they can go to their well-heeled donors. For the individual investor, they need to determine in advance what is their illiquidity bucket. And I've actually written a paper on that to really help advisors think through how we should think about how much to allocate. Yeah. And I'm not suggesting it's 50, 60%, but maybe it's 10%. If you think of that illiquidity bucket as being your true patient capital, which is the way institutions and family offices think about it, that's actually a good thing. That's instilling in individual investors a disciplined approach to a pool of their capital. Mm-hmm. If they get emotional and they feel uncomfortable with the market, with their traditional investments, they could be a little bit more tactical. They could be more defensive, taking risk out of the market, or they could be opportunistic if they see attractive opportunities elsewhere. But at least for a portion of their capital, it would be really good to instill that long-term disciplined approach. That's the way that Yale thinks about it. And that's, I think, a skill that is transferable to individual investors. It's actually an attribute that we should try to develop with individual investors and advisors to think long-term in nature.
Absolutely. It may be you're referencing the same paper, but it goes hand in hand with, I think, what you wrote about. There's a cost of being too liquid. Right? If you want to speak about that, I think it's interesting, and I think most people, and I guess I don't want to get into investment advice, but like we look at 401k plans and we have these long time horizons, 40 years, 50 years, however long people may be in there. And it is largely liquid products in there, right? Mutual funds or whatever it may be. It's fascinating. So moving on to current, you leave Schwab, which we didn't talk about, but you left Schwab and then you started your own consulting firm. And I think this is something I wanted to learn a little bit more about. So you got to a point in your career where you wanted to do your own consulting. What were you focused on then? And then how did that lead to the transition here? Because you started a separate podcast, it seemed, in parallel.
Yeah, so it's interesting. I've been doing this for a long time. I work at some great firms like Morgan Stanley and Guggenheim and Schwab, and I just wanted to be my own boss. I really thought that at this stage of my career, it'd just be nice to kind of pick and choose the things that I wanted to work on. And it was funny because I very quickly gravitated to developing alternative education programs. I worked with iCapital in the development of Alts Edge. I did some work with the Investment and Wealth Institute in developing their private markets for alternative program. I did some consulting for a couple large family offices, which I found really interesting and great work to do. And then, as I mentioned, Franklin Templeton had hired me to build out their alts education. And I was like, that's a great fit for me, great organization. And I really thought it would be a project that would end and I would go on to the next project. And as I mentioned earlier, I think Franklin Templeton recognized the importance of having that ongoing voice, to have that constant drumbeat of information. And they understood that education was, part of the DNA of the firm, that it's important to make sure advisors use these tools appropriately, that individual investors understand the risk and the return characteristics. So I was fortunate that the firm created a role for me in the Franklin Templeton Institute, which is an independent think tank within the organization.
Mm-hmm.
I never talk about products. My sole focus is helping advisors make better informed decisions about allocating capital. As you mentioned, I write deep dive white papers. I have a podcast. I have a blog series. I spend, way too much of my time out on the road speaking at conferences or meeting with clients directly. But it helps inform what I write and talk about. You mentioned the cost of being too liquid. And that was a direct reaction to the feedback I was getting from advisors over and over again. When I talk about allocating capital to private markets, they would say, yes, but it's illiquid. And I'm concerned about that. And my clients are concerned about. And in fact, if you look a lot of the industry research, that's the number one or number two issue in all the surveys that come back. What are the impediments for doing more private markets business? It's this illiquidity. And I said, well, rather than view that as a negative, I think we should actually lean into it as a positive, because what we can do is take that emotional impulse away from the individual investor and actually instill that long-term discipline, that patient capital that we really want investors to have. But it's so difficult when they can actually emotionally pull the plug at any point in time. So that paper, interestingly, has been my most sought after and most published paper. It's even been published twice in 2 Australian publications, and I don't even know how they got it.
Wow. Wow, that's awesome. So what are we talked a little bit about the beginning, but I want to dive into how you find topics to write about for your white papers. I want to spend time talking about your podcast too, which is amazing. And then, but before that, what is the best overview of your role? I've heard you describe it on other your episodes and in your white papers, but your primary goal is or part of it, to educate advisors on just alternatives in private markets, and then how right,
yeah,
they can access. So do you want to go into kind of your primary focus here in this role, and then we can talk about white papers and then the podcast too?
Yeah. So, very, very simplistically, my primary focus is really helping advisors make better informed decisions about allocating to alternatives. So I never talk about Franklin Templeton products. I really try to understand what are the challenges that they face. So a lot of the stuff that I write about and speak about really comes from discussions I'm having with advisors, whether it's be understanding liquidity or the how to help allocate capital. So I think you could almost kind of divide a lot of the work that I do into 2 barbell sort of approaches, because advisors on different paths on their journey.
No doubt.
You have power users who understand how to use this, and they're primarily focused on how do I make discrete allocation decisions? Where's the best opportunity to deploy capital today? We have advisors who are using it, but they're dabblers. They're not doing it on a full-time basis. They're not fully incorporated across their book of business. Right. And they're looking for, well, how can I use it broadly across all my clients? Because if I can't scale it, it becomes very clunky. I've developed a whole series called Building Better Portfolios, which are really designed to help through portfolio construction and using case studies to illustrate the impact of that over time. And then the third sort of advisor out there are the skeptics. And for the skeptics, I have a whole series of content that I produce, which is really around the notion of why alternatives, which really helps arm them with the intellectual argument around why do these asset classes make sense? What do they do for client portfolios? What does the historical data show us? What are some of the lessons learned from institutions? So what I'm trying to do is match up the content for wherever that advisor is on their journey, and to hopefully help them get a little further along in the journey, with the expectation that those who are skeptical today, once they have a positive experience, become more comfortable, make bigger allocation decisions, have better outcomes for their clients, which lead for them to think about using them in a more meaningful way over time.
And is there an advisor segment that your efforts are kind of strictly geared towards, or is it high net worth all the way down to median income? Like, is there any geographic market that is the soul of this, or is it just kind of widely any advisor market that
we're trying to be as broad as we can,
okay.
But again, the message is tailored to those market segments. So at least in my mind, I always know in advance, if I'm speaking at a conference, I always know where the advisors generally sit on that journey. And I think, as you and I were talking about earlier, there's always the there's always the challenge to speak so you're not speaking above the advisor where they feel uncomfortable, but maybe enough above them to challenge them to think differently about the way that they think about alternatives. So I would say I'm generally available everywhere. I'm generally trying to speak to everyone, at least everyone who's interested in alternatives. If you're not interested, that's fine. There's enough other things that you can be doing with your time. But I think, again, in the States here, I generally feel that most advisors recognize they need to be having this conversation with their clients. Yeah. And I often challenge them that if they're not having those discussions, I can guarantee other advisors are. The advisors at Morgan and Merrill and UBS are definitely going to be talking about it. The advisors at Ameriprise and LPL and all of the firms are starting somewhere on their journey. So you need to at least be conversationally proficient and understand what they are. I think what's interesting, and we haven't gotten into it, but it is interesting at least, Franklin Templeton is a global company with a global footprint. And I'm hearing from peers in Canada and EMEA and APEC, there's a lot of noise and interest coming from those markets because they largely want what we have here, right? They want to understand alternatives better. They want more alternatives at their disposal. There's an interest, I think, globally, as everyone's kind of recognized these better tools can provide better outcomes for their clients.
Digging in on that a little bit more, how do you, in something I put in the prep sheet, but how do you evaluate? We have these 3 different segments that you focus on, but how do you decide on what you're going to write white papers on? Where does the idea come from? You said it sometimes comes on the road, but no one has a gun to your head of, hey, Tony, we need more content. So what moves you to write a certain piece? And like, what is your research process for compiling data to support or not support your hypothesis? Like, how do you produce different white papers?
Well, the good thing is nobody puts a gun to my head and tells me what to produce. It is largely driven by the feedback that I hear from advisors. So, again, we want to have kind of a foundational level sort of library of content, which really speaks about the merits of all the asset classes. Mm-hmm. So the major food groups, private equity, private credit, private real estate debt, secondaries. We have a library of content there. The Building Better Portfolio series really came out of that challenge that advisors were having with the house. So we built out a whole series of that, which originally just started as a foundational sort of way of thinking about allocating capital and using these case studies. And then I thought the next logical sort of evolution of that was thinking about real estate. I think you and I talked about it a little bit earlier, that I think real estate represents retirement represents a huge opportunity for advisors as they think about how do we solve for outcomes? We know that big pension plans have historically used alternatives. Why wouldn't we think about that in our retirement plans, whether it be the IRA or the 401k menu? And I think that kind of caused me to kind of think about that a little bit more. The one area that we haven't spoken about, which is a little bit more of a sequencing sort of event, is the research that we do on our private market outlooks. So as we speak here today, we're finalizing our 2025 outlook. That's a pretty deep, intense sort of process where we're constantly throughout the year looking at what's happening in the space, where do we see opportunities, and then we hunker down for a couple months, just pull together all of our research to come out with a set of views that where we think the best opportunities are on a going forward basis. I'll give you the punchline, and then if you like, we can certainly delve into it. But, as we think about 2025, we think the top 3 opportunities are secondaries. We think secondaries are really attractive here, both from a fundamental and a structural perspective. We like private real estate, which I know you'll like hearing. We think after it's been beaten down over the last couple of years, valuations look attractive, and we need to look beyond the office sector. Mm-hmm. We think there's great opportunities in industrial, multifamily, life sciences. And we actually like real estate debt, which is an interesting sort of way of playing what's happening in the real estate space and taking advantage of some disruption that we anticipate coming in the near-term future, as a lot of that real estate needs to be financed, and we know banks are going to be reticent to lend capital. Yeah. We think private credit managers can step in, and there's an opportunity to help on the debt side, be a lender. So those are our top 3 ideas, and that's the culmination of research that we do throughout the year, just looking at what's going on, where we think the best opportunities are, more of a macro lens as we evaluate the market environment.
So what's the evaluation process of putting that together? And is that the culmination of multiple researchers or contributors in-house that are putting together that annual piece there?
Yeah, it's the culmination of a lot of research that we do throughout the year. So it's not something we just wake up and start. We literally do it all year round. And the work that we do this year will help inform the way that we look about next year. But we're fortunate. We actually have research people all over the globe. What's interesting about the Franklin Templeton Institute is we really are a global think tank. I have colleagues in Scotland and India and Poland and Asia, and we're all constantly looking at things. And in particular, we have a really bright analyst team based in India. And we've been thinking about where are the opportunities. So on an ongoing basis, we're constantly looking at research. Again, we had a 24 outlook. Our outlook in 24 wasn't completely dissimilar. We like secondaries, but really the real estate debt story is a relatively new story for us. We did research on that earlier in the year, started to publish some research on that. Real estate, we were a little more concerned last year. There's still a lot of noise going on. We didn't think valuations had truly reset. But as we have been following the space throughout the year, we got more comfortable, valuations coming down. We've always believed that there are opportunities outside of the office sector. And we always thought that the market was overreacting with their singular focus on office representing the whole space as opposed to one sector, a sector that likely has a secular challenge in front of them, just as people are moving out of office buildings. And we don't think that that's going to solve itself in the short order. But certainly areas like industrials look really attractive to us as you think about the Amazon fulfillment centers or the reshoring of America where manufacturing comes back here. So we've always tried to have a much more broad sort of view on what the opportunity set is.
Wow. Transitioning to one thing I really want to talk about that we didn't give enough time to early on, which is your podcast. So Alternative Allocations. Can you give an overview of what you're trying to accomplish with the show? And I think it's a great show. If you haven't listened to it, definitely please listen and subscribe to your show.
Thank you.
But who are the types of guests that you typically have on? And then what is typically kind of the episode structure or type of story that is to be told on the show?
Yeah, I love your podcast, by the way. So thank you for mentioning mine. I love yours. Yours is a deeper dive. And I think one of the things that we were thinking about with the Alternative Allocation podcast is we're thinking about advisors who are potentially going to the office or at the gym. So I think early on we decided we need to make sure that it's relatively short. So our podcast is, we try to be 20 to 30 minutes. We try to focus around allocating to alternatives, right? So have a focus on how this could be actionable and used by an advisor in their practice. We have ground rules, no products, no promotion, which I think just it works a lot better for the advisor, right? Nobody wants to be sold to.
Absolutely.
It's easy enough to get information on various funds available in the marketplace. They don't want to be sold to. They want somebody to help them. And I source guests from a lot of different places. And one of the things after doing it for a little over a year and fortunate enough to win a couple industry awards, we're fortunate to win the Wealthy this year and also won the Star Award from the EMEA Association. So a couple industry associations recognize the value of it. We now have people calling us. And what we're really trying to do is we're trying to think about what are the trends in the industry. So I think our most recent podcast guest, we had a multifamily office CIO because I wanted to ask him about how he allocates capital. Sometimes we'll have somebody on who's a portfolio manager because we want a deeper dive on a space like real estate debt that we talked about earlier. We thought that was fairly unique. A lot of advisors haven't really thought about the debt side of the equation, and we thought a deep dive there would be warranted. We've leveraged industry experts like Matt Brown or Nick Veronis to talk about their critical role as being kind of the key of the infrastructure for, allocating capital. We've had folks from Cerulli talking about some of the research that they do on what are the trends, where's the growth, product evolution, and those sort of things. And I try to make sure I always have an advisor who might be more relatable to our audience who could talk about how they think about allocating capital. But it's really exciting to me because we have people coming to us all the time with ideas. And I think what we're trying to do is just make sure we're talking about things that are relevant for our audience. So we definitely, when I'm traveling, Interestingly, a lot of advisors are already listening to the podcast. That's a positive thing. But they'll often volunteer, hey, it'd be interesting to hear about retirement because I talk a lot about retirement. Well, one of my upcoming guests will actually be from DeKalb talking about some of the work that they're doing in showing the regulators the value of allocating to alternative and DC plans, which I think is a huge opportunity for our industry. So I kind of feel like I'm in the catbird seat. I get to invite all these great guests to come on and talk about things that personally I find very interesting.
You've spoken to so many great people on the show, but you've also been in alternatives and private markets for a very long time. What do you think did anything stand out that you've learned from the show, from these other titans that you've had on the show, that you found as new information, or anything that you kind of picked up through doing the show or having these conversations solely centric around alternatives that you thought was new or nuanced to you? Any learnings through doing the show?
I
stand out.
Yeah, I probably learned something from every one of my guests, which is, fascinating because a lot of them are friends and people that I've known for a long time, but I always pick up something from our guests. I think the one thing that may be worth sharing for your audience is, we talk about this next generation of products that have come to the market. I'll just call them evergreen. I think some of the naming makes it confusing, whether it's interval, tender offer, non-traded REITs, private BDCs. Let's just call them evergreen. Those are strategies and structures that are on the shelf continuously versus drawdown, kind of the first generation of structure. And it's interesting, a couple of our recent guests who primarily are focused on the ultra high net worth family office sort of environment have both mentioned that these new funds, again, these evergreen funds can be kind of gateways or on-ramps to getting exposure to the strategies. And they actually view both of these strategies, kind of the evergreen and the drawdown, as complementary strategies as opposed to one versus the other. And it's something that I believe, but it was interesting to hear them talk about how they use it. And I think part of the reason that's important for advisors is sometimes advisors are skeptical. It's kind of their nature, and I encourage them to be skeptical and ask tough questions. And I think sometimes what they believe is these new structures coming to the products are lesser products. Yeah. And hopefully for them, it's actually comforting to know that big institutions and family offices are using the same vehicles. They're actually using the same vehicles. They might be using them in a different way because they're using them as a complement to their existing exposure, but they don't view them as lesser vehicles. They're just different. There are different structural sort of trade-offs along the way. And I found that really comforting hearing it from their voice as opposed to me saying it.
That makes sense. Transitioning from FT to the book, typically each episode will go over a deal story, but I think this is a great deal story. So this is your second book, but Private Markets is the book. What moved you? Why was now the right time for this book? And if you want to dive in and give an overview of the book, that would be great. But also, who is the book for? What's the sole purpose of the book?
Yeah, it's interesting. I wrote a book, and I think I was kind of joking with you earlier. My publisher said, "What's easy to write a book, it's hard to write. It's hard to sell a book, right? It takes a lot of time and effort." And I wasn't really sure that I had the time for either. But in my travels, I was absolutely convinced that there was a need for a deeper dive book. I would typically speak at a conference. I'd walk off stage, and I'd have discussions in the hallway for another hour, and I felt like there really wasn't something comprehensive. You could get that short little snippet, but you never really had the opportunity to tell the whole story. And although the book is primarily written for the sophisticated advisor who's on that journey somewhere along the way, whether they're the dabbler or they're a power user, I think hopefully everyone gets something out of it. It's also written in mind that the individual investor needs to understand it. So you've listened to my podcast, and I think if I do anything well, it's probably I try to take things that are fairly complicated, like private markets, and make them easy to understand and digestible. So I thought with the book, what was really important is to use a lot of case studies, whether it's case studies of getting them to understand what private equity is, where I talked about kind of the growth of, Google and Tesla and how seed capital early on helped fuel those ideas, which ultimately became companies, which became household names that we all recognize today. I think sometimes advisors kind of lose sight of the fact that a lot of these great companies that they think of household names today started as an idea, and it's the private equity capital and the private equity expertise that helped nurture that company along the way. I try to use examples there. I try to use as much as I can kind of plain speak and research to make points as opposed to just making statements and leaving people hanging. There's an illiquidity premium, just leave it. Well,
right.
Why is that? Why is there an illiquidity premium? How is it that private equity managers are able to unlock value over time? So I tried to provide something that would really work for advisors of all stages of their sophistication. And I think it would work for individual investors who often get confused with all of the jargon and maybe are hesitant to ask their advisor, what do you mean when you say J-curve? Or what do you mean by a capital call? What is that? So it's a little ambitious, but I tried to write it with all of those constituents in mind without dumbing it down so it didn't work for the primary audience, which is the sophisticated advisor who's been on this journey for a while.
Wow. In diving in, we outlined when we chatted about a couple different chapters that I wanted to spend time on. So some of these questions are derived from those, but we mentioned it earlier, but I think now would be a good time. Like, how have private markets evolved since your early days of seeing it at a family office where really the retail investor probably couldn't get access to anything unless they knew someone doing a deal locally, right? How have you seen private markets evolve, and then really juxtaposing that with what is the true opportunity and where do people have access now? Because it's apparent everywhere, right?
It really is. And, it's something that I think everyone wants to talk about. Everyone wants to understand the journey, where we've been, helps inform us of where we're going. In the early days, I don't even know that we called private equity. It was just we're investing in young companies with entrepreneurs in mind, with the hope and the expectation that some of those deals would pan out and we would be handsomely rewarded for it, and others would fail and go by the wayside. But I think today it's really become, apparent that advisors are looking for those bigger set of opportunities. So I without making it too simplistic, I think one of the things that I often focus on with advisors is something that's relatable to them is I compare public markets to private markets. And again, I'm not suggesting it's one versus the other. I think that it's one and the other.
Right.
But the reality is that the public markets have been shrinking over the last couple decades, right? So we currently have about 4,000 private companies. There were 8,000 at the turn of the century, right?
Wow.
In 20 years, we've essentially shrunk in half. Conversely, if we think about private markets are growing. There are over 19,000 companies with 100 million or more in revenue. That's a growing universe of opportunities. And one of the other sort of factoids that we look at is those companies are now staying private longer. And the reason they're staying private longer is there's an abundance of capital. In the old days, when I worked at Morgan Stanley, and I had the opportunity to work with a lot of Google executives, Google had to go public. It's the only way that they continue to fuel their growth. There was no other choice. It's the only way of getting capital. Now, you don't have to go public.
Right.
You can stay a private enterprise for a lot longer or maybe forever because you can get capital to fuel your growth. The example that I often use is Elon Musk has SpaceX. I'm not sure that Elon Musk is ever going to bring that company public. He has enough scrutiny for the public companies that he's involved with today.
That's for sure.
So there's really no reason for SpaceX to go public because if they can get the capital and they can remain a private enterprise, they're not forced to meet quarterly shareholder reports and disclose all the things that they're doing and be beholden to the public scrutinizing every decision that you make along the way. So I think there's been a real change in the way that we think about public versus private. Private companies are growing. They're going to stay private longer. And if you're the CEO of one of those private companies, you have the ability to execute a long-term strategy. You don't have to answer to shareholders. You don't have to think about my earnings from one quarter to the next. If you could truly be a long-term investor in those companies, we believe you're going to be handsomely rewarded for it. So the reason I also frame it that way is because I do often get, comments from advisors. Are we concerned about so much money going into the space? Does that illiquidity premium all of a sudden go away? And I'd argue No, because I think that universe continues to grow.
Right.
Going to your space and the real estate space, I often kind of joke with advisors, they'll make the comment about, well, I don't really need to have exposure to private real estate because I've got publicly traded REITs. And you're chuckling now, and I cringe when I hear that, because I think, as you know, if you look at it, publicly traded REITs are essentially small cap stocks, right? They have a 0.69 correlation to the overall market. They react and respond much like a stock does every time there's a shock to the market, where private real estate represents a vast opportunity. Similar sort of dynamic. The private real estate market is 90% of the overall pie. So there's a vast opportunity that is growing there. So when I look at the private markets, they are growing, they're expanding outside of our borders. So we spend a lot of time thinking about what's happening here in America.
Right.
But I can tell you again, going back to my colleagues in EMEA and APEC and other parts of the world, they're starting to see the growth, and they're interested in the opportunities investing in private markets as well. So I think these markets are growing and going to provide vast opportunities for investors and advisors over the next decade or so.
So the markets are certainly growing, but also the products are growing or evolving, in which like people actually have access with lower investment criteria now too. So how have you seen that evolve? And do you think that's a direct correlation with the market growth as well, of like, there's obviously more investment that can be raised for those. And what do you think, were there challenges when you saw the evolution of some of these private vehicles? Were there challenges with those products over time of maybe mismanaging the asset or whatever the underlying product is, that duration or timeline with the liquidity of when people can get in and out of the product, right? I think that can create a big mismatch over time, maybe.
I think you're
speculating,
right. I think you're right. And I think that, look, as an industry, we try to evolve and learn. I would say, just very broadly, I'm excited about product evolution. I'm excited where we are. I'm leery of going beyond where we are. So, to
as defined by what? Almost too liquid again?
Too liquid.
Yeah.
Right. I think what makes private markets special is the fact that they are underlying illiquid investments. And if I'm investing in private markets, the expectation that I'm going to capture that illiquidity premium. Mm-hmm. I encourage advisors, even though some of these vehicles and the marketplace will sometimes refer to them as semi-liquid, I encourage them, think of them as being long-term investments, right? It's the only way you're going to capture the illiquidity premium over the long run. You can't invest in it today and get out of it tomorrow and expect to have the same experience. So when I think of products, I spend a lot of time talking to advisors about products, and in the book and in each of my chapters that I talk about the individual asset class, I make sure I talk about products because I want to make sure advisors understand how it is that they can access it. The first generation of product, there's nothing wrong with that. That's still where the preponderance of the assets are, but they didn't necessarily work for everyone. They work for institutions and family office. They're available for qualified purchasers, $5 million or more in investable assets. They had high minimums. They had high lockups. They delivered K1s. Nobody likes K1s.
Right.
But other than that, the structure itself, there's nothing wrong with it. And it gave those managers the ability to manage assets for the long run and deliver those oversized returns. Nothing wrong with that. But it didn't really work for all investors. And the beauty that I see is this evolution that has gone on is we now have these evergreen products. And evergreen products could be non-traded REITs, private BDCs, interval or tender offer funds. But let's just call them evergreen because the nomenclature gets confusing because they're always on the shelf. They're typically available accredited investor or below. Therefore, they're available to a lot more clients. Lower minimums. They're evergreen, which means they're on the shelf, which means for an advisor who may have to have a lengthy discussion or several discussions with a client to get comfortable, it really works for the way that they allocate capital. Where a drawdown fund, you typically have a finite period of time to convince them that this is a good investment. And if you can't make your investment in that period of time, you're going to miss out on it. So it's more conducive to the way that advisors think about allocating capital. But to my point earlier, what I like about them is they also provide protections for the managers. And I tend to look at things from all perspectives, not just, that, hey, it's beneficial. It looks and feels a little bit like a mutual fund. It does a little bit, but what's really nice is it also provides the protections for the manager. The manager can invest for the long run. They can buy illiquid investments in the pool, and they don't have to worry about meeting, daily NAV and all of the things that failed miserably when we think about the first generation of liquid alternatives, right? You're forcing something into a structure that really didn't work very well for what you were solving for. So to me, I just accept illiquidity. That's part of the benefit, which also means that it has to be part of the underlying structure. So as the industry, there's noise around, ETF versions of these and whatever. I'll let other people far smarter than me figure that out. But what I don't want to do is I don't want to force an illiquid investment into a liquid structure. I've seen that movie before, and it didn't work out so well.
Yeah. What do you think in spending time on the road? And I'm sure there's a couple answers to this, but as you've outlined your three segments of different advisors in their journey, so to speak, what do you think is the largest challenge for advisors? Not that a private market or alternatives is for everyone, right? I mean, at the end of the day, like it is your choice. But what do you think the largest hurdle is, or knowledge hurdle of advisors maybe not fully understanding the value, or like what do you see the challenge for them being in gaining their investors access to, or advising them on access to alternatives? What do you think the biggest challenge is, do you think?
I think the biggest challenge is the next order discussion. It's the discussion with the client. So I think more and more advisors are getting comfortable. They understand it. They understand the intellectual argument. They understand what the data shows them. They understand the structure. So they're getting there. They're not, all of them are black belt at this point, but they're definitely getting there. But the biggest challenge for advisors is generally having that discussion with the individual investor. And part of it is they need to be confident that they can answer all of the questions, right? Spending most of my career working with advisors, and I appreciate, the challenge of them sitting in the seat that they sit in. They don't want to have a discussion with a client if they can't anticipate and answer all of the questions, right? The worst thing would be that they have a discussion with a client. The client looks at the data and says, hey, this is great. What's the difference between an interval and a tender offer fund? And the advisor doesn't have an answer. They feel embarrassed. They feel uncomfortable. Or they get a question that they really don't understand. What's the difference between IRR and MOIC or something like that? So we need to make sure that we prepare the advisor for that next level discussion. And I think one of the things I am very mindful of in the stuff that I write and the stuff that when I speak to a group of advisors, I'm always trying to speak to them in terms that they can hopefully turn around and parrot in their words, but communicate it to individual investors in the way that they will understand it. And I think that is a challenge because the industry overall, we tend to use a lot of confusing jargon. And we all know that individual investors, and a lot of advisors too, by the way, when you don't hear the terminology that you're comfortable with and it sounds confusing, you think it must be more risky. What you don't understand feels more risky. It's a behavioral element built into everything that we do. So if they hear a lot of this jargon and terminology, they say, this must be really confusing and very risky, therefore I don't want it. But if we can break it down in simple terms that they understand, why are we adding these investments? What role do they play in portfolios? Public markets and private markets are a different part of the same ecosystem. All of a sudden, if they can get more comfortable, they can embrace it and use it in the right way. So if we can help advisors have that better discussion with their end clients, that's a win for the overall industry.
Absolutely. One of the chapters in your book, maybe chapter 8, but talks about portfolio construction, so how things are evolving right now. Jockeying on our last kind of topic there, being there's a lot of new products. So with new products, there's new access. With this new access, now that may change of like how people allocate as opposed to your standard 60-40. How do you think portfolio construction is going to continue to evolve now that this is now something new people can have in their portfolio? So where do you see the future of portfolio construction for most folks?
Yeah, and as I mentioned earlier, we have a whole series of papers and presentations on building better portfolios, and in that we use case studies. And I like to use the case studies, and I like to make them relatable. So I actually create client personas, and they're real clients with balance sheets and risk and return and incomes and liabilities. And I try to make it feel real so an advisor can ultimately take it back to their book of business. But the beauty of the structures that we have today, lower minimums, is I'll go through a series of cases, and maybe for a larger family, I can actually have a diversified pool. So rather than making a single decision on adding private equity, I can actually have private equity, private real estate, private credit in a portfolio. So I get a diversified solution. Gee, that's a really good thing.
Right.
That's the way that institutions and family offices allocate capital. If I'm solving for growth, maybe I'm going to have more private equity. I'm going to have more private real estate, and maybe I'm going to use a little hedge fund, like an equity hedge type strategy. If I'm more defensive in nature, maybe I'm going to use my private credit, my private real estate, and my macro strategy. So I try to tease out how these tools can be used in a more precise way, similar to the way that family offices and institutions use them, which is depending on what I'm solving for, growth, income, defense, or a combination of all of the above, I can use these tools in a more diversified way, and I view them as more precise tools than what the 60-40 portfolio provided. And again, I think generally advisors get this, right? I think 2022 was a little bit of a wake-up call for advisors that, the 60-40 portfolio is an incomplete toolbox, right? The 60 and the 40 were both down double digits that year. It shocked advisors, and frankly, it shocked clients, because clients kind of woke up to this notion that advisors have been telling them, the reason the 60-40 was our arbitrary benchmark is I got all of my growth out of my 60, I got income from my 40, and I got some level of ballast because stocks and bonds didn't move in lockstep with one another.
Right.
Except for 2022, or virtually any time there's been a market shock over the last decade. Anytime there's a shock, all of traditional investments move in the same direction. Think of COVID. Think of any of these short-term shocks that we've had. We don't get the shock absorbers when we need them the most. So I'd argue that the reason we need that expanded toolbox is the markets are different today. And the beauty is the markets are different, but you have tools that can help solve for the market environment that we're in.
It's a great description. One big question, and we talked about it earlier, is where do you think the values and what is the evolution, right, in this modern day of private credit? So it feeds into real estate, obviously, but it feeds in everywhere. And there's a lot of buzz around private credit right now, and I think it's growing massively. But where do you see the evolution of that continuing to go? And maybe where did you see it start in your days? So focusing in more just on private credit and the opportunities there.
Yeah, so private credit is interesting in the sense that it's really a business that grew out of the market crash, right? So after the GFC, the private credit industry really exploded. And the reason it did is because after the GFC, banks were hesitant to lend to small to middle market institutions. Yep. Private credit firms kind of stepped up to fill that void. I see a similar sort of parallel today. In a post-Silicon Valley bank environment, banks are reticent to lend capital to risky assets. Private credit managers can step in to fill that void. So we do see a lot of the similarities there, where private credit managers now can dictate terms and conditions as they look at lending capital to small to middle market institutions, to real estate companies that will need to refinance in the next couple of years. I do think with all the money flowing into private credit, though, I think one of the things that we talk about in our upcoming outlook is we anticipate a larger dispersion of return in the next decade between the winners and the losers. And the reason is that there are experienced managers who have managed private credit through multiple cycles. Mm-hmm. And there were newer managers who saw all the flows going into private credit and said, I too can manage a private credit fund. And I think like everything, when you go through multiple market regimes like that, at the end of this, a decade from now, we'll look back and we'll likely see the winners were substantially better than the losers. And that dispersion, which is typically much wider for private markets generally, will likely be larger over the next couple of years. So that's one of the macro themes that we've been talking about in our outlook. And we think in private credit in particular, you're going to start to see that dispersion widen.
Wow. And kind of going on that thread a little bit further, and I think this could be a good kind of wrap-up point on the book portion, but everything we've discussed is great and super applicable, and I think a lot of actionable steps. But one of the big questions I think a lot of people have is, how do you go about selecting a good manager of any of these strategies, right? One of the notes, maybe in your papers, but the 4Ps maybe came up.
Yep.
If that goes into line with selecting managers. But it seems probably one of the hard questions for advisors to answer, or how would they go about it? What is your philosophy, or what do you think is an appropriate way to evaluating a good product or a good manager, rather?
Yeah, and I think that that's clearly one of the big challenges for advisors. So I try to ground things in things that I think most advisors understand. So the 4Ps are the way that we would typically evaluate an SMA, a mutual fund, right? Focusing on the people, the philosophy, the performance, right? And those are things that are relatable to them. Now, of course, the nuances are, some of this is different, right? I mean, it's very different in the private markets. We don't necessarily have the same sort of track record that we're looking at. So I'd argue that somebody needs to do due diligence. For a lot of firms, their headquarters are doing due diligence. For some firms, they're leveraging third parties that are doing due diligence. So clearly what we want to do is we want to make sure that somebody's performing some level of due diligence so we can evaluate the depth and the resources of the team. Do they have experience managing through multiple market regimes? Do they have dedicated resources to help source capital? Because allocating to private markets is very different than the traditional space. It's really about having a network, having experience doing it in good times and bad. And it's really important to have deep and dedicated resources there. So again, we encourage advisors to leverage work that may be done by others. It's not to say that they shouldn't do their own due diligence, but I think a lot of the firms' headquarters do a lot of that. I know, working with a lot of the firms that we work with across the country, they have due diligence people who are doing that. So that should be some level of comfort that at least they've made it through the gate, which means they've at least filled out kind of the baseline. They've got a strong track record. They've got the experience and all of that. The other thing I often talk about when we talk about due diligence, though, which you'll appreciate, is the investment due diligence is fairly straightforward. It's right. The ODD, it's the operational due diligence, which is often the problem and the challenge. And there I try to encourage advisors, even if there's some level of due diligence, I would ask the funds that come in your door, and operational due diligence will focus on things like, do they have adequate checks and balances? Do they have cybersecurity? How do they price securities, right? I mean, that to me is a really important one. And I always encourage the advisors, ask those tough questions of the people who are coming in your door trying to sell you a fund. Make sure you understand how they price securities. Ask them questions about, who are the other funds available in this space, and how do you compare to your like competitors? So leverage the managers. If they're going to walk in the door, try to get your time and attention, ask them the tough questions about their own funds and the funds that they see in the marketplace. But I think at the end of the day, they should make sure that they're comfortable investing before they can. So if they can't understand and articulate the story, understand what makes one fund different and better than the next, they should probably pass on it.
I think that's a good point. I think that's a great summarization of what we kind of outlined to talk about on the book side without giving away too much. But is there anything, prior to a couple wrap-up questions, is there anything else book-related that you wanted to comment on that we didn't cover in those couple segments there?
Yeah, so when you write a book, again, you have the ability to kind of look through a longer lens. So I wanted to provide kind of the basics. The last 3 chapters of the book are really focused on the future. And I try to peer into the future and imagine what the world would look at like. So I do that through a macro lens perspective. Where do I think the growth opportunities are going to be in the wealth channel? So I talk about which areas of the market we're big fans of. Secondaries, we think secondaries will be a really important part of that. We're starting to hear a lot more interest about infrastructure, which has historically been a big institutional tool, not necessarily in the wealth channel. We think that's an area that will grow over time. We talk about the areas that we like real estate and real estate debt, but we talk about it through a macro lens perspective. We also talk about some of the trends that we're seeing in the industry, and I didn't do this in a vacuum. I did a lot of research and looking at some of the work that Case and Cerulli and others have done and where the trends are around advisor adoption, some of the things going on. One of the areas that we touched on just a little bit that I did talk about in the book is this notion that I think retirement looks to us to be one of the biggest opportunities out there, as I think the regulators have signaled that there should be access to private markets and retirement plans without giving the answer of how. And there's been a lot of industry groups. I mentioned Decalta. There's been lobbying by asset management firms and other industry groups to really understand how we can do this. But I think that's going to be a growth area when all of a sudden we start to see more access to these great strategies in your 401k plan or target date fund. So stay tuned on that. And then lastly, I talk about what I think the implications are. So as an industry, let's just say we're 5% allocated to alternatives broadly. I think that's what the numbers generally say, although you could quibble about what's in that alternative bucket. And I think some would suggest that maybe that's even high. But if 5% is the number today and directionally we think 15 to 20% actually starts to make a difference in client portfolios, how do we get there? So I go through thinking through, what are some of the implications of that and what does it look like as we start to bring these strategies to Main Street? And I address head on some of the concerns that I hear from advisors. Do we think that all of a sudden they get watered down if they're too broadly available? And the punchline is, no, I don't think so, because I think that universe continues to grow and continues to get more granular and continues to be an expanding and growing universe, which I think provides really interesting opportunities for us. So those last three chapters were interesting to me as I wanted to peer into the future and offer something different than just where we've been, but maybe more important, where we're going.
Wow. I think that's a great wrap on the book side. And when's it coming out, if you can talk
February
about
11th.
Okay. And where will it be available as well?
It's on Amazon now for pre-order. And I would say, the book was truly a labor of love. And as you and I were talking about it all earlier, it's kind of the culmination of my career. And as I was writing it, I was recalling back those early days working for the family office and how we thought about this. And my vantage point working with a lot of those young entrepreneurs who might have brought their company public when I was at Morgan Stanley, and how they understood the value of running a private enterprise and the value that they could create as a private enterprise and how that changed once they hit the public markets. And I also thought about my current role and the interactions that I have with advisors. So it was really kind of a fun exercise to go through as I tied together all of these elements of my career. I was also kind of touched, my dear friend John Bowman, who's the CEO of Kaya, or the incoming CEO of Kaya, he's currently the president, was kind enough to write a foreword to my book. And it was very humbling as he kind of talked about where we are as an industry and the importance of this book as really kind of filling a void that I think exists in the market, something specifically written for advisors and investors about allocating to private markets.
Wow. Really excited to read it, and fortunate enough to get the preview to prep for this show too. So last couple questions, Tony. What these kind of go hand in hand, but like, what are you focused on now? And I know we talked a lot about it, but if there's anything else, like, what are you solely focused on now? And then what do you think your future looks like? You've accomplished quite a bit in your life and in your career. Is there anything you haven't done, or maybe is there anything you haven't done FT related that you would like to do, or externally as well? So what does the future look like?
I love what I do. As I mentioned earlier, I thought I would be semi-retired, and the reason I took this role is I thought this is a perfect role for me. It allowed me to do what I like to do and what I think I do best. I enjoy working with advisors. I enjoy writing. I enjoy speaking. And I think all of those things kind of feed off one another. So I'm very excited where I am. I'm really excited to see where the industry is going to evolve to in the next 5 to 10 years. Hopefully I will be part of that evolution as we get there. But I think this is a great time for advisors and investors. We have access to more products than we've ever had before from world-class managers. And for the first time that I recall in my industry, in my history in this business, the industry is kind of coalescing around the fact that we all need to help advisors make these better informed decisions. So it's not Franklin Templeton competing against another asset manager. We are all collectively working together to help advisors make these better informed decisions. So I think it's a really exciting time. I'm just glad that I'm on for the journey.
Wow. You've been around a lot of really smart people over your career. Who do you think in your career helped you the most, whether that be in the investment world or just overall kind of in just your career evolution? Who do you think played a pivotal role in your life, in your career?
There are so many people. And, one of the great things about writing a book is I wrote an acknowledgement, and I had the opportunity to thank all of those people. And I was fortunate, my boss at the family office really gave me just incredible values that I take with me today. I've had the opportunity to deal, I kind of call it my Nobel list. I've met a lot of the Nobel Prize laureates just with some of the work that I've done in sponsoring and speaking at conferences, and I've become close with people like Harry Markowitz, God rest his soul. And I've really worked with some incredible advisors, and I have a real appreciation for the value of an advisor because I've spent so much time working with the best of the best out there. So I've just been very fortunate. And in my book, I have the opportunity to kind of thank all of those people who are critical and help shape the way that I think about investing and think about this world that we all live in. And again, I'm appreciative because I've learned from everyone. And I think if we look back at our career, we realize we get a piece from everyone that we've interacted with over time, and it helps shape who we are.
I love it. I think that's a great place to wrap up. Tony, thank you for coming on the show. Is there anything that we missed that you wanted to plug at the end? Of course, listen to Alternative Allocations and subscribe and get the book when it comes out. But is there anything that we missed, do you think, in your story that you wanted to close with?
No, Matt, this has been great. Thank you so much for having me. Thank you for all the great work you do. As you and I were talking about, I think podcasts are the future. It's the way that people consume information. I love your long form. You have the ability to have these deep, interesting stories with great people across the industry. I've enjoyed listening to many of your guests and their journey. I think we're all richer from that.
I appreciate that. Tony, thanks for coming on the show. Appreciate it.
Thank you.